The high volatility that was present in the market during the past week provided a roller coaster ride for gold's price, yet the precious metals price remained in a largely sideways motion. Today we are to discuss the fundamental challenges laid ahead for the precious metal, but we'll be concluding this report with a technical analysis of gold's daily chart. On the monetary front, we note that the Fed remained on hold as was widely expected. In its accompanying statement, the bank seems to be taking its time regarding the possibility of any rate cuts. We expect that the bank may start cutting rates in the summer and deliver 3 to 4 rate cuts in the current year, a scenario that, if materialized, could keep dollar supported on a monetary level. Given the negative correlation characterizing gold and the dollar, such a scenario may start weighing on gold's price over the first half of the year. Yet we would expect to see more signals regarding the Fed's intentions in the coming few days, as Fed policymakers are to proceed with their post-decision statements. The main market mover of the past week may have been the release of the U.S. employment report for January. The release shook the markets as, despite consensus for an easing of the tightening of the U.S. employment market, the actual rates and figures highlighted its resilience. The release as such tends to allow more leeway for the Fed to maintain rate high for a longer period, as one part of its mandate promoting employment is covered and forces the bank's focus on bringing inflation down to its 2% target. Market-wise, the release obliged the market to reposition itself and provided substantial support for the dollar in Friday's American session, weighing on the gold's price again. We expect fundamentals to guide gold's price in the next few days, given the low number of U.S. high-impact financial releases expected, with special focus being on the Fed's intentions. Yet we would note the release of the U.S. CPI rates for January next Tuesday as the next big test for gold's price. Should the rates slow down further, we may see the release weighing on the dollar and thus providing a lift to gold's price. We also note the path of U.S. yields, given the competitiveness between gold and dollar's bonds as safe haven assets. Should U.S. yields continue to rise, we may see them having an adverse effect on gold's price, as attention may be shifted towards U.S. bonds, given also that the gold is non-interest-bearing asset. On a technical level, we note that gold's price hit ceiling at the 2055 resistance line and moved lower, bouncing on the 2013 support level yesterday. Currently, we tend to maintain a bias for the sideways motion of gold between the 2055 resistance line and 2013 support level to be maintained. We base our outlook practically on the fact that the price action of the precious metal was unable to clearly break either of the pre-mentioned levels since the start of the year, thus forming a corridor for the price action to move within. Furthermore, we note that the RSI indicator tends to run along the reading of 50, implying a rather indecisive markets, while the Bollinger Band have narrowed, implying less volatility for the price of gold, which may allow the sideways motion to continue. For a bullish outlook, we would require to see the precious metals price breaking the 2055 resistance line and aiming for the 2019 resistance nest. On the flip side, should the bears take over, we may see the bullion's price breaking the 2030 support line and aiming for the 1972 support base. And that's a wrap on today's financial highlights. Stay in the know, and we will catch you next time right here at IronFX.